Are you feeling just absolutely frustrated by the constant emotional whiplash of volatile markets? Look, if you're a retail investor trading with a smaller account, you probably know exactly the pain I'm talking about. You know the feeling, right? You finally buy into a breakout that looks incredibly strong, only to watch it aggressively reverse the very next minute, leaving you completely trapped. Well, welcome to today's explainer. We're going to master 7 ancestral trading instructions that are specifically designed as an antidote for small capital investors. These are the golden rules you absolutely need when you're getting chopped up in ranging markets and, let's be real, just don't have the luxury of staring at a computer screen all day long.
So, here's our roadmap for today. We'll start by surviving the slow bull, move into the psychology of discipline, learn how to master the intraday clock, decode those tricky technical turning points, and finally, wrap up by building your trading muscle memory. Let's just dive right in.
All right, part 1, surviving the slow bull. Before we deploy any new tactics, we really have to understand the battlefield we're stepping onto. A slow bull market? Yeah, it's not that steady, comforting climb we all hope for. It's actually a grueling environment of short, aggressive cycles. Think like 2 days up, immediately followed by 2 days down. It's like a pendulum. And if you're trading with smaller capital, these sudden whiplash cycles are going to trigger your stop losses constantly and just slowly bleed your account dry. Traditional buy and hold strategies or, momentum breakouts, they completely fail here because the trends simply don't sustain themselves. When the market moves like this, we need an entirely different playbook just to survive.
That brings us to part 2, the psychology of discipline.
This is where we establish the foundational mindset you need for everything else we're going to talk about. There's this fantastic old trading adage, buying requires patience, while selling requires determination. I love that because short-term trading is rarely about picking the absolute perfect stock. Honestly, it's entirely a mental game. You need immense patience to sit on your hands and wait for the perfect, calculated entry when literally everyone else is blindly buying the hype. But on the flip side, you need cold, hard determination to sell and actually take your profits when the greed in your heads is whispering to hold on for just a little bit more. You see, our biggest enemy in the markets isn't some high-frequency trading algorithm. It's our own biology. Your emotional instinct screams at you to panic sell during a scary drop or to FOMO buy when a stock suddenly surges to the moon. To win, you absolutely must accept counterintuitive signals. You have to actively suppress that primal fight-or-flight response. It's all about trusting a strict system and executing rationally, while the rest of the market is just running entirely on panic and greed.
Okay, part 3, mastering the intraday clock.
Applying this strict discipline means knowing exactly what to do at different hours of a highly volatile day. The time of day heavily dictates your rules of engagement. Right at the opening bell, if there's a sharp, unjustified drop, the instruction is actually to add to your position. What you're usually seeing there are just panicked retail traders shaking themselves out. Throughout the rest of the morning, if prices drift lower, hold your ground. Do not sell into weakness. And then, as we enter the afternoon session, if the market suddenly pulls high, do not chase it. No way. Late-day surges are very often traps designed specifically by larger players to catch latecomers right before a dump. Time of day also dictates how we actually take our profits. If a stock experiences a massive surge in the morning, determination is required. You clear your position completely. Why? Because the morning brings peak liquidity and usually the absolute best prices of the entire day. But if that massive surge happens in the afternoon, well, simply reduce your position to lock in partial profits. You never ever want to assume an afternoon run will carry over to the next day. The morning is always your preferred, safest exit window.
And we apply a really similar logic to market crashes. We know a sharp morning drop is often a temporary shakeout, right? It's an opportunity to add to your position immediately. But an afternoon crash, that is an entirely different beast. If the bottom falls out late in the day, patience is absolutely paramount. Hold your fire. Do not try to catch a falling knife right before the closing bell. Just wait until the following day. Let the dust settle overnight so you can evaluate the actual damage and find a much, much safer entry point.
Moving right along to part 4, reading technical turning points.
Now that we've mastered the clock, we need to decode the secret language of the charts. Identifying true market turns is tricky. First, understand that a sudden sharp rebound is almost never a true bottom. True bottoms take time to form. They rarely bounce back instantly in some perfect V-shape. So to avoid falling for fake temporary rebounds, stick to these core rules. Buy when a price correction pulls back but completely fails to break its previous low. That higher low, that shows hidden market strength. Conversely, you want to sell when a rebound fails to break a previous high. That lower high is a massive signal that the buyers are just exhausted.
Our final technical rule relies on understanding something called divergence.
Divergence happens when you see massively high trading volume, but the actual price of the stock barely moves at all. Think of it like revving a car engine while you're stuck deep in the mud. Lots of noise, lots of effort, but zero forward progress. This is a critical, highly counterintuitive signal that the current trend, whether it's going up or down, is completely exhausted and a reversal is imminent. So here is exactly how you trade that divergence. If the market is in a strong upward trend, but suddenly you see massive volume with a stagnant price, the buyers are tapped out and sellers are secretly unloading. You sell, get out. On the flip side, if the market is tumbling downward, but heavy volume finally stops the price from falling any further, that means institutional buyers have quietly stepped in to absorb all that panic, so you buy. The volume always tells the true story that the price action is trying to hide from you.
Finally, Part 5. Building Muscle Memory.
Knowing these rules intellectually is only half the battle. Now we've got to make them completely automatic. To shift from emotional panic to cold instinctive execution, you have to actively build your discipline. First, consciously acknowledge when a signal feels counterintuitive. Just expect it to feel wrong. It's gonna be uncomfortable, and that's okay. Second, practice continuous reflection. After the closing bell rings, review your trades. Honestly assess if you followed the rules or if you let your emotions drive. Over time, doing this establishes a personal rhythm. You eventually build actual muscle memory, perfectly bridging the gap between these theoretical rules and your real-time, in-the-moment market temperament.
So I'm going to leave you with a simple question to ask yourself right before your very next trade. Will you continue letting the market's chaos dictate your emotions? Or will you put in the daily work to forge the muscle memory required to master the slow bull? Thank you so much for joining me for this explainer. I really hope you step back into that volatile, but now entirely conquerable financial battlefield with absolute clarity and confidence. Catch you next time.